Welcome, everybody. My name is Alish Eisner of the Canadian Money Talk. This is my friend Rob of the Mindful Investor. And welcome to part two of our personal finance podcast, if you will. So we will begin where we left off previously. We're going to start on question number 8. And if you haven't had a chance to look at the first part of our podcast, please make sure you do that. So we will continue here with the question of how are you splitting your asset allocation, meaning real estate versus stock versus bonds versus other types of assets, for example, private equity.
Yes, splitting asset allocation. I try to keep it 50-50, but it's never exact because I don't go measure like my real estate market price every now and then. It's but my main active investments are from the stocks. So whatever I make there, I kind of have a waterfall strategy. So I branch out to other gold or Bitcoin and other things. So I try to maintain 50%, 50-50.
Okay. Do you do bonds at all?
Yes, I do bonds, but just recently because I just started a all-weather portfolio, and that requires some short-term, long-term bonds and some gold as well. And I never had exposure in those, but it's good to diversify.
All right, cool. So for myself, I did a quick look at my portfolio, and so the condo where I live and the 3 investment properties add up to about 30% of my total net worth. Stocks and ETFs are about 36%. Mutual funds are about 28%. And then I have private equity, which is about 6% of my total net worth. I do very little in bonds. I actually don't own any mutual funds that have bonds directly. I do have some balanced funds, which are stocks and bonds, but I certainly don't have individual bonds or anything like that. So to me, it's been because of the interest rates being so low that if the interest rates go up, the bonds take a hit. So I've sort of not wanted to get into bonds, and I kind of let the professionals handle it in mutual funds. The private equity is there as a diversification, and private equity is just small companies that need investments, and so I've bought them in $10,000-$20,000 increments in various companies, and so far it's been okay, not great certainly. So
Okay, and how about gold? Do you have any exposure in gold?
yeah, gold. I'm not a gold person.
Okay.
I don't see the intrinsic value. It really only has value that somebody else places upon it. You can't eat it. It doesn't pay you dividends. It doesn't have any utility really, other than as jewelry. Like it can't make you stuff.
Okay.
Bitcoin, I'm sort of like that as well, except that it doesn't even have the history that gold. So what
Yeah.
about you? What percentage do you think, or any?
For all the miscellaneous like gold and bonds and bitcoins left, it's probably less than 5%. So so ultimately it doesn't even matter.
Well, I've heard advisors say everybody should have 5% of their portfolio in gold.
Yeah.
I think that's sort of more of a personal decision. Some people like it, some people don't. To me, it's a speculation, but other people see it as an alternative investment type. Bitcoin as well. So
Yeah, it is. It's kind of known that gold and Bitcoin shouldn't correlate with the market or the real estate. That's why people diversify into that class.
well, real estate is a different animal in that because it's not liquid at all, when there's some sort of a panic, people can't sell it overnight or during the day. It takes 2 months to sell and so on. So it tends to be more stable. If it's rented, it has cash flow. So
Yeah.
so that is definitely different from gold or Bitcoin, but it has real estate has utility at least, and you have. To me, it's interesting. I have friends who are either all stock and real estate is only to be lived in by them, or they don't trust mutual funds or stocks and they just like real estate. There's
Yeah.
not that many people who kind of,
Dabbles in both sides,
yeah,
like ourselves. Yeah.
yeah, who dip their toes in both of the ponds. So I think these are all very personal decisions, just what you feel comfortable with.
Yeah.
And if somebody forces you to get into something you're not comfortable with, the first problem that exists, you're going to pull out. So it's better not to, anyways.
Yeah, yeah.
So,
And I think there's a point that you said some friends, they just consider their own like primary resident as a real estate investment. It's you can't really look at it that way, I don't think, because if you sell it, you have to find a new place to to live anyways. So unless you downgrade and then you get cash out. So it's not really investing in real estate when you're just buying it to live in yourself, maybe.
yeah, that's an interesting philosophical discussion. You're right. Some people count their primary residence in their investment portfolio because it is an
Yeah.
asset and it can go up and down in value. But then they say, I have no intention of selling it, so I'm not really going to count it. I mean, you count it in your net worth, obviously.
Yes. Yeah.
Uh, but yeah, a friend of mine is looking for an investment property, and I tell him, well, then you're going to have two houses. You're going to be really overweight in real estate. You should maybe get some more mutual funds with stocks or something like that. And he's like, my house where I live doesn't count as an investment.
Well,
So
yeah.
so yeah, I've had those discussions, and yeah, you could argue that for hours and never really get anywhere. So
For
uh,
sure.
yeah, so you're fairly evenly split. Uh,
Yeah, I try to be, yeah.
yeah, okay. And I'm kind of 30% real estate and 60%, let's say, liquid, and then 5 to 10% the private equity isn't very liquid at all. So yeah, just over the years, I think I mentioned this in part one. Over the years, as I was accumulating money, I never really accumulated enough to buy another house, another investment property. So it just kept going into stocks or mutual funds. So yeah.
Yeah.
All right. On to question number 9. It's sort of in the same vein.
Yeah, so basically, do you have any other types of investments like mutual funds, index ETFs, individual stocks, or other investments? Do you have, yeah, I know you have like many individual stocks, right?
Yeah. So it's I'm about 40 odd percent in mutual funds and about 60% in individual stocks.
Okay, and
Uh,
how many are there? Just approximate.
yeah, way too many. I kind of let my portfolio get out of control. Like
Okay,
I built myself a mutual fund out of my
pretty
individual
much.
stocks.
Yeah.
And the experts say you're supposed to have 10 to 20 well chosen, well kept up to date stocks. Because once you get past 40, and I definitely have past 40, you're pretty much just mirroring the index. Like
Yeah. Have you ever like measured the performance against the index or against your other mutual funds?
I have, as far as my brokerage goes, I'm definitely outperforming a TSX
Oh.
with, but that's not that high a bar. Let's face it.
But your investments are mostly Canadian companies or they're all like American, international, all everywhere?
They are mostly Canadian companies because I try to get dividend paying companies, and the Canadian stocks get pretty much no taxes on the dividends that they pay. Like you pay zero taxes up to about $50,000 of Canadian eligible dividends. So that's why I've been targeting Canadian companies that pay dividends. It hasn't worked out well in a total return scenario because a lot of them are energy companies and they've just taken a beating. So yeah, they're paying the dividends still, but they went down in price, and so the net result isn't really positive other than having cash flow.
Right.
Recently, I started taking my U.S. rental checks, and instead of converting them to Canadian and buying Canadian stocks, I've branched out and I started buying American companies.
And are there also dividend paying companies that you're targeting?
No, actually, again, keeping the taxes in mind, foreign dividends are taxed a salary, so they get taxed really hard. So I've been aiming for companies that I'm expecting to grow in price.
Oh, speculation
And
plays.
sorry,
Speculation plays.
not speculation. I mean, we're talking Google and Microsoft
Okay.
kind of companies, where if they pay a dividend, it's fine, and I'll grin and bear the taxes. But I'm expecting them to go up in price, so then I pay capital gains taxes, which are taxed preferentially. So I think my investing club has had some influence because they're into American stocks, and I can't bear the conversion back and forth because you always pay a penalty. And so now I'm taking American dollars and throwing them in. But so what about you? Canadian, US, other?
I made videos of this. I have like I think 6 or 7 stock portfolios, and some are designated for Canadian dividend stocks. Some are for just growth stocks like yourself, like some Google, Microsoft, Amazon, Apple, all those. And then there's it's all over the map, but I enjoy it. And sometimes if I don't want to think about it, I buy the index. So there's a VFV and with Vanguard that I buy a lot, which
Mhm.
mirrors a S&P 500 index. And I do have a very different type of investment vehicle that I believe 99% of the people don't have.
All right.
And it's burial plots in cemeteries.
Okay.
Yeah, and there are a lot of upsides. Like there's no management fees, so once you buy it, you don't have to pay management. You don't have to pay any of those, but you don't collect dividends either. But it's set by default to have an appreciation of 7 to 10%, and that's based on the company that runs the cemetery. That's how much they sell the plots for, and it increases 7 to 10% every single year. If you ever visit them, that's what they tell you, and that's what they do. And then I believe that's like a real estate play as well because the land is limited, and I just buy like outside plots, so I don't buy like the stuff inside the building, like the urns and whatnot. It's definitely different. It's just another way of diversification, I
Okay. So
guess.
so where did you dig up this investment?
I just noticed like there's a huge arbitrage actually. Like these pieces of plots back 30 years ago was worth like I don't know a couple $100 to like 1,000. But if you go to the cemetery right now and ask the officer if you want a plot, they'll quote you I think 50, 60,000.
Oh wow.
Yeah, but you can find like these unused plots on Craigslist from like people who don't plan to use it for under 10,000. So I think that's the arbitrage there. But then this is very, very illiquid. You have to find a buyer, but then once you find it, they say they see the what 40,000 discount. They can easily just fork it out, but it's hard to find them. I never tried finding them. I just plan to start selling it maybe 20 years down the road.
Okay. Are you going
Yeah,
to keep one for yourself?
possibly. It has great views.
Yeah. See, I wouldn't care where I'm buried, whether by the fence or by the road, or like it doesn't, to me, it doesn't matter. But, and so do you buy them from Craigslist or do you buy them from the cemetery?
Not from the cemetery because everything they sell is like 50, 60 grand. And there's no way I'm going to buy that. Yeah.
Okay.
No.
Well, I mean, there's no property taxes or anything, no insurance. So I kind of equate this to an empty plot of land that you're waiting for the city to get to as it expands.
Pretty much.
Same kind of an idea, except
Yes.
it's a more controlled environment, but also you don't know if you're going to be able to get a buyer, just really like for real estate.
Yeah. And there's no like running costs like property taxes or other things like that.
Okay. Yeah, there's no maintenance or anything like that paid on it.
No maintenance, no.
No, like they mow the lawn and stuff. I thought there might be some.
Yeah, they charge you when you use it. When you use it, you have to pay extra fees to dig things up and put someone in there. I think that's when they charge you for mowing the lawn, but there's no maintenance fees like before or after.
Okay.
Yeah,
Oh,
it's very interesting. It's
yeah,
different.
absolutely. I mean, there's whatever people are willing to pay for, right? I mean, who would have thought that hockey cards or stamps or comic books, but that's a common thing that people invest in, art.
Yeah,
So
yeah.
why not? Okay, well that's a new one. Okay, all right. So question number 10. Do you take advantage of TFSA and RRSP? Do you plan to withdraw early from RRSP before the age of 71? If so, what are your early withdrawal strategies to minimize RRSP tax penalties?
Okay, so for RSP, I don't plan on withdrawing anything because I don't have too much in it. I only had like maybe 5 years of contributions into that account, and all I have in that account is just one stock, Google. And then and then my plan is just like 30, 40 years down the road, whatever it's worth, I'll just slowly sell like one share for $10,000 and then that's good for the year or something. And for my TFSA, I go for the growth tech stocks, like what we mentioned before, the FANG stocks, and then a lot of AI, like NVIDIA, AMD, and then fintech stocks like Square and PayPal. I just plan to hold on to like 11 of these stocks for another 20, 30 years. And I also have some options in the TFSA account, like long-term options, like 2, 3 years out. And then that's where I try to get like more returns within the account.
Okay, and then it's tax free, so if there's a larger return, you get basically no
Yeah,
taxes on it.
yeah, that's my plan. Yeah.
Okay, all right, cool. So I have money in both the TFSA and RRSP. I keep buying into my TFSA actively on a monthly basis via 3 index funds. So it's just dollar cost averaging in $458 every month, which times 12 is 5,500, which used to be the old limit. I stay away from putting in additional money into the RRSP because I'm incorporated, and so in order to put money into the RRSP, I have to pull extra money out of the corporation, and then I get the exact same tax benefit by buying the RRSP as the extra taxes that I paid for to pull the money into, from the corporation into my personal. So it ends up being a big zero, other than burning RRSP room. So uh, if I get money that I earn personally, so for example, when I sold one of my properties and I had a bunch of income or capital gains from it, then I did buy RRSPs with that money. But that's the exception. Otherwise, I don't really use RSPs. So, like my general strategies would be to hold on to anything that's tax deferred as long as you can. Uh, I think I'll start pulling money out of the RRSP when you have to at 71. And in the meantime, I'm going to live off of either contract work, or live off the dividends, uh, either in my corporate assets or in my personal stocks. Now, kind of an interesting thing is, I had a financial plan done a couple of months ago, and my original plan would be to take old age security as late as you can. You can take it as early as 60 or as late as 70 years old. And I was going to take it at 70, and that actually maximizes the amount that they'll pay you. But of course, they're paying you for a shorter period of time. It's 6% per year. So at 65 is kind of neutral. If you start at 60, then you're getting 30% less, but you're getting it sooner. And if you start at 70, you're getting 6% per year more, so 30% more, but you're starting later. But what the financial planner said is that, well, it looks like you're going to have RRSP withdrawals and so on, so you're going to have a whole bunch of income, and so that old age security is going to get clawed back. And so she suggested to actually start the old age security earlier, because you get smaller amounts, but you're now getting them for 10 years extra, and you're getting them in the years when you're not being forced to pull RSPs. So that kind of changed my mindset, which I found very interesting.
Okay, when you said that the old age gets clawed back once you start withdrawing your RSP, is there like certain amount? Let's say if you're making, let's say 20,000 income, like that's when they break that threshold, and
it's higher. I can't tell you the exact number. I think it's somewhere, if you're kind of making in the 70,000 per year today. I think the clawback starts, and I think once you get to like 90 or 100,000, please don't quote me on the numbers, but it's something like that. They claw back more and more. So by the time you're like 90 or 100,000 a year, you're not getting any old age security at all. You apparently don't need it.
well, that's when so you're saying by age 60 or 70, you can possibly be pulling 100,000 from RSP per year, or including like dividends and all the other income.
Well, the dividends are going to keep coming no matter what.
Yeah.
But at I believe 71, you're forced to start pulling RRSPs.
Oh.
And so that bumps up your income. And so if you just started receiving old age security at 70, now your income is dividends plus RSPs plus old age security. So they're going to claw some of it back, the old age security. But if you start taking the old age security early, you basically get to collect on it for 10 years at a lower rate, but without any danger of a clawback, because you're not forced to pull the RSPs yet.
Okay.
Yeah.
And this old age, like what kind of numbers are we looking? Like, is it flat for everyone, where it's like $1,000, or?
Yeah, it's not significant. I think it's like 12,000 a year today. I think it's inflation adjusted, but it's not significant. But I mean,
it's free money. It's free money.
It's free money that being a Canadian citizen, and living here. So yeah, that was just kind of an interesting observation. Obviously, as the day nears, I'm gonna do more analysis and run more simulations, and see what happens as it gets closer, because it's kind of interesting to me how you have to make decisions on a bunch of guesses and unknowns. Am I putting money into TFSA? Am I putting into RRSP? Is it better to leave it in the corp? Is it better to put it in a non-registered account? And like, I don't know what's going to happen, and I could be making decisions now that are totally wrong, but but anyway, as things get closer, you can make adjustments at that point.
Right. And do you find using a financial planner helps with this process? And do they charge you anything for it?
So this one happened to be free.
Okay.
I attended a conference and they were offering free financial plans. Also, a portfolio manager from her office phoned me and gave me, I sent in my portfolio and he gave me a couple of hints, which I thought were good to hear because I'm always just getting my opinion on my portfolio, right? And of course, as far as I'm concerned, it's perfect because that's how I designed it. So to hear somebody tell me, you really should have some bonds, and I'm like, this is the reason why I'm not buying bonds. And he goes, well, back in March when everybody was selling stocks, they were putting that money into bonds, so bonds went up. So I'm like, okay, well, something to think about. All of his suggestions, I kind of was able to give a counter to, and this is why I'm not
Yes.
doing it. But it's good to hear somebody else's voice other than your own. Which is why if you have, a fee only pay by the hour financial planner, if you have a couple of million in investments, spring for that $2,000-3,000 every couple of years to have them look at your portfolio. Like I said, I got it for free because of a conference. Obviously, they were trying to drum up business, so
Yes.
I felt a little bad, but apparently not bad enough. But both the financial planner and the portfolio manager, they were both great. They spent about an hour with me. I mean, it's just data entry into a system. To go off on a tangent really quickly, most financial planners use basically a spreadsheet where you put in some variables and it spits out a nice curve based on the inflation that's expected, the return that's expected, and so on. But it's only one number. If you use Monte Carlo simulations, it will actually run 1,000 times and it'll run it on a normal distribution as far as what the results are, rather than putting one static number. It uses that static number as an average, but it says, okay, 1 year it's below, next year is above, again above, and it uses statistics, and it will run it 10,000 times. So you'll get numbers like your portfolio is 90% likely to be worth, 8 million. I'm making this up.
Really?
So it's Monte Carlo simulations, and you can use free online ones if you just Google them. Are very cool for financial planning. That it's not just a calculation, but it's it'll run it 1,000, 10,000, whatever times.
Right. But you have to input like a lot of metrics into it, and that's assuming you have in like all the asset classes they label, right?
Yeah, you have to say I have this much in bonds, I have this much in small
Yeah.
cap, large cap, and so on. And actually, the simulator that I used online, I'm sure there's others, but the one that I happen to use, it went and said, okay, this is what the average small cap index does per year, and here's the standard distribution with standard deviation and so on. And then based on what you said it had, it would run it based on its own statistics. You didn't have to provide the averages or the standard deviations or anything like that. So
Okay.
anyway, just it's kind of the
Interesting.
next level of how to analyze your portfolio, because I mean otherwise
Cool.
it's just a
Good
spreadsheet,
to know.
right? Just like well, here's an example. When you like when I got pitched to get a financial advisor, they always show you these lovely nice curves of how your portfolio is going to go up. They're just using the average and they're making it nice and smooth, but the portfolio
Yeah.
doesn't actually do that. It does this. It
Right.
has that upward slope,
Yeah.
definitely.
Yeah.
So the simulation captures that, because it captures one year it's up, next year it's down, as opposed to being up 7% year after year after year after year, which doesn't happen. And the simulations also capture the timing risk. So for example, if you have a couple of bad years at the beginning, that really destroys your portfolio, and then it's really hard for it to come back. But if you have several good years and then you have a couple of bad years, it's not a big deal. And so the simulation would capture some of those.
Yeah, but I think all this only works if you like truly apply to the system like 100%. Like for us, for instance, like we put in more money when the market crashes, and we don't do things regularly, and we don't have bonds, we don't have certain asset classes. We have our own like tried and true method, I guess. So that wouldn't like like make any sense for us, I don't think.
Yeah, it's true.
Yeah.
Some of the financial planning software, I mean, it can build in that you're putting in $1,000 a month, dollar cost averaging. So
Yeah.
in that case, it'll capture that. The Monte Carlo simulation that I used, I don't remember if it had that you're still dollar cost averaging in. But in the end, you get these lovely graphs, and you can see everything, and it gives you. Yeah, financial plans are great. Uh, they're of course forward-looking 40 years, and so many things can change by then, as I had said previously. So
Yeah, I bet that's like pretty much a disclaimer for them. That's that these are projected estimates,
sure.
and yeah, so it's all a nice picture, but yeah.
Well, and financial plans should be a living, breathing document, which you should redo, I would say, every 3 to 5 years, and definitely if something changes in your life, divorce, new child, whatever it is, inheritance, I think you
Yeah.
should refresh